90%. That's how much of its taxable income a real estate investment trust has to hand to its shareholders every year, and that single number is why this product exists at all. But I want to start somewhere harder than the number, because this corner of the outline hides one of the cleanest traps on the exam. Two products, both hold real estate, both send you money. One of them will pass its losses through to your tax return, and the other one never will, and candidates mix them up constantly. And there's one thing a limited partner can do, entirely by accident, that strips away the protection they bought in the first place. We will get to what it's.
The two products are a real estate investment trust and a direct participation program, and the honest way to hold them apart is to stop thinking about the real estate. The real estate is the decoy. What separates them is the legal wrapper and what that wrapper does with the tax consequences. One is a company. The other is a partnership. Everything else follows from that, and it's worth naming why anyone built the partnership version at all, because the tax treatment isn't a loophole somebody found. Real estate development is capital hungry and slow. Early years often show accounting losses even when a project is going well because depreciation and interest land before the rent does. A structure that hands those early losses to the people funding, it's a structure that can actually raise money for a long project. That's the design intent, and understanding it makes the flow-through rule feel inevitable rather than arbitrary.
Company versus partnership, that's the whole fork, and everything else is detail hanging off it. Get that one question right and the rest of the comparison answers itself almost every time.
And FINRA defines a direct participation program by exactly that feature, which is worth reading closely because the definition is unusually blunt. It's a program that provides for flow-through tax consequences, regardless of the structure of the legal entity. Regardless of the structure. So it doesn't matter whether the thing is a limited partnership or something else. If the tax consequences flow through to you, it's a direct participation program.
Leo, put the consequence in plain terms. If I own a piece of one of these and the property loses money this year, what lands on my return?
A loss. Your share of it, on your own return. One asset, two wrappers, two completely different tax outcomes.
And that's precisely what a real estate investment trust will never do for you. A trust is a company. It has its own tax existence. If it has a bad year, that bad year stays inside the company. You might see the share price fall, you might see the dividend cut, but no loss arrives on your tax return to offset anything. The partnership hands you the loss. The company keeps it, and it changes who each product actually suits, which matters more than the exam does. Somebody sitting on a large passive income stream looking for something to offset it has a real reason to prefer the partnership because those losses are worth something to them. Somebody who simply wants exposure to rent-producing property inside an ordinary brokerage account has no use whatsoever for a loss they can't deduct, and every reason to prefer the liquid company instead. Neither one is the better product. They answer different questions, and the exam tends to hand you the question rather than the product.
Which is the sentence I'd carry into the exam room. And if you want to drill this until it's automatic, there are free practice questions and study material for the whole exam waiting at certs.richresourceful.com. One thing before the next part, and then we move right on. If any of this is clicking, tap that like, hit subscribe, and ring the bell for the next one. It takes a second, it costs nothing, and it helps more than you would think. Professor Ferreira, don't give me the general version, narrow it. When somebody buys into a limited partnership thinking they're protected, which part of that belief is actually true?
Depends which protection you mean. Pick one. Protection from losing the money you put in, or protection from being chased for what the partnership owes.
The second, being chased.
Then the belief is true, and it's the entire reason the structure exists. A limited partner bears limited liability. The most they can lose is what they committed. Creditors of the partnership can't come past that line to their house or their savings. Compare that to the general partner who has exclusive power to manage the partnership and unlimited liability. That's the trade at the heart of every one of these deals. One side runs it and is fully exposed. The other side stays out and is shielded. And notice the symmetry because it's what makes the structure hold together rather than merely being generous to one side. The person carrying unlimited liability is the person with exclusive control. The person with no control carries no exposure beyond their commitment. Control and risk.
Erica, exclusive power to manage. That phrase is doing real work in there.
It does, and it's where the accident we teased lives. The shield isn't a receipt you keep in a drawer. It's conditional on staying passive. A limited partner is defined as somebody not involved in the day-to-day management of the partnership. Start directing operations, start making the management calls, and you can be treated as a general partner with the unlimited liability that comes with it.
So the well-meaning investor who wants to help
Can help themselves straight out of their own protection. It's the cruelest small print in the product, and it's exactly the kind of thing the exam likes because it rewards understanding the trade rather than memorizing a label. And there's a hierarchy worth carrying for when one of these winds down, because questions reach for it and it follows plain common sense once you see the order. Secured lenders come first because they hold specific collateral. General creditors come next. Then the limited partners who put up the money. The general partners are last, which sounds harsh until you remember they're also the ones with unlimited liability if the money runs out before the creditors are satisfied.
And I'd name the harder problem, because liability isn't what actually hurts most investors here. Illiquidity is. There's no active trading market for these interests. You generally have to hold for a number of years to realize the benefits at all. So somebody who needs the money in 3 years has bought the wrong thing, no matter how sound the underlying property is.
Say more about what no active market means in practice, because I think people hear it as merely inconvenient.
It means there may be no buyer at any price when you want out. Not a worse price. No buyer. That's a different category of risk from a stock that fell.
No bid at all. Not a worse price, no bid. That's the part people miss, and it's the part that ends up mattering.
Let me tell you about the shape this takes in real life, because I've watched it happen. Someone retires, gets handed a lump sum, and puts a large piece of it into a program with a genuinely attractive property behind it. 3 years later, a medical bill arrives and they go looking for a way out, and there simply isn't.
Not one, no exit at all. And the sales pitch always leads with the tax benefit, never the exit.
None. And the property was fine. The property was never the problem. The mismatch between the holding period and their actual life was the problem, and that's a suitability question, not an investment quality question. And that distinction is worth holding on to, because it's the difference between a bad investment and a bad match. Nobody was defrauded in that story. The building kept collecting rent. The product simply had a shape that didn't fit the shape of that person's life, and the job of anyone recommending it's to notice the mismatch before the money moves rather than after.
Which is why I'd push back gently on how these get sold. The flow-through losses are real, and for the right investor, they're valuable. But those losses are passive losses, and passive losses generally only offset passive income. Somebody expecting to shelter a salary with them has misunderstood the product, and that misunderstanding is usually the reason they bought it.
So who is it actually right for?
Somebody with passive income to offset, a long horizon, and no need for this money. That's a narrow group, and it's smaller than the group that owns these.
Professor Ferreira, thank you for drawing the line where you did.
Though you did make me want to check my own holding period.
Check it. That instinct is the whole lesson, and it took you 2 minutes longer than it should have.
So back to the 90%, because a real estate investment trust has to earn its treatment, and the exam wants the 3 tests that prove it.
Michael, the reason the tests exist is the interesting part. A trust that qualifies avoids being taxed on the income it distributes, which is a genuine privilege. So the rules make it prove it's really a real estate business really passing income along, rather than a company using a label.
90% of taxable income paid out annually.
That's the first and the famous one. At least 90% of taxable income goes to shareholders as dividends every year, which tells you something useful about the product before you learn anything else. A trust can't hoard earnings the way an ordinary company can, so it's structurally an income vehicle rather than a growth vehicle. And it's worth being precise about what the 90% is measured against because the wording trips people. It's 90% of taxable income, not 90% of the rent collected and not 90% of cash flow. Those are different numbers, and taxable income is the one that has already absorbed depreciation and expenses. So a trust can pay out well over 90% of its taxable income and still be holding cash, which is why the payout you see quoted and the 90% test are rarely the same figure.
And the other two tests are about proving it's genuinely in the business.
Both of them, and they're both 75%, which is the mercy of this topic. At least 75% of total assets in real estate assets and cash. And at least 75% of gross income from real estate-related sources, which includes rents from real property and interest on mortgages financing real property.
90, 75, 75, three numbers, and the order never changes. Income test, asset test, income sources test. That's the sequence I'd write on the scratch paper the moment the exam starts.
And that second 75 is quietly telling you the three flavors exist.
That's where the wording of the test genuinely pays off. Notice it named rents and it named mortgage interest as two separate sources. An equity trust owns the buildings and collects the rent. A mortgage trust holds the paper and collects the interest. A hybrid does both. So the definition itself hands you the taxonomy if you read it slowly. And that's a habit worth building for the whole exam, not just this corner. The tests are written to be precise rather than friendly, so the words carry information that a summary strips out. Read the requirement, notice what it names separately, and the categories usually fall out of the language without you having to memorize a list somebody else made.
Rents from property, interest on mortgages, two named sources, three product types. Equity owns the building, mortgage lends against it, hybrid does both, and the exam will say which.
And there's one more consequence worth carrying, because it's the honest downside of all that mandatory distribution. Because the trust isn't taxed on what it distributes, the distribution generally arrives in your hands as ordinary income rather than at the friendlier dividend rate. So a trust can be a fine holding and still be a poor fit in a taxable account, which is exactly the sort of trade-off worth naming out loud rather than pretending away. And the practical version is worth stating plainly, because it's the part that changes what somebody should actually do. Hold one of these inside a retirement account, and the mandatory distributions land somewhere they aren't immediately taxed, so the structure works with you. Hold the same trust in a plain taxable account, and you've signed up for a yearly stream of ordinary income whether you wanted the cash that year or not. Same investment, and the account it sits in decides much of the outcome. Which is useful to know before you own one, and it never appears in the marketing material because it's not a flaw in the product. It's a flaw in the pairing, and the pairing is the part the investor actually controls.
And put the two products next to each other one last time, Erica, because that comparison is the episode.
A trust is a company, liquid if it's listed, income by mandate, no losses to you, distributions taxed as ordinary income. A program is a partnership, illiquid by nature, flow-through of income and losses, limited liability that depends on you staying passive, same bricks underneath, completely different instrument in your hands.
That's where I'd leave it. This pair rewards understanding the wrapper over memorizing the asset. And once you see it that way, the questions get noticeably easier. If that landed, a like helps other people find the series, and subscribing puts the next episode in front of you while this is still fresh. I will go first on this one. The thing I got wrong for years was assuming anything holding real estate must behave like real estate. It doesn't. The wrapper decides. So here's my question to you. What's something you assumed behaved one way because of what was inside it? Think about it, because that habit shows up all over this exam. I'm Michael, and I will see you in the next one.